Now come to question number 18. Amla Limited purchases a 100% subsidiary, okay, for rupees 10 lakh at the end of 20x1, when the fair value of the subsidiary's net asset was rupees 8 lakh. The parent sold 40% of its investment in the subsidiary in March 20x4. 100 minus 40. So it means parent is still retaining 60% of the investment to outside investors for rupees 9 lakh. So 9 lakh is cash received. The parent still maintains a 60% controlling interest in the subsidiary. So control is not lost. Then what we will do in that case, if control is not lost, we will transfer the amount to NCI. Okay. NCI stake will increase. The carrying value of the subsidiary's net asset is rupees 18 lakh, including net asset of rupees 16 lakh and goodwill of rupees 2 lakh. Calculate the gain or loss on the sale of interest in subsidiary as on 31st March 20x4. What is the amount realized? 9 lakh. What is the value of 40% stake? 40% of 18 lakh. 7.2 lakh. So what is the gain? First, we will write down in separate financial statement. In separate financial statement, we will just compare the sale proceed with the cost of investment. Right, sale proceed 900 rupees in 1000. Cost of investment in subsidiary. Cost of investment in subsidiary 10 lakh into 40%. 4 lakh. 400 in rupees in 1000, 400. And gain on sale in parent separate financial statement 500. So in SFS, the gain shown would be 500. In CFS, sale proceed write down 900. In CFS, sale proceed 900. Recognition of non-controlling interest. Net asset. What is the 40% of the net asset? 18 lakh into 40%. How much? 720. Therefore, gain will be transferred to other equity. 900 minus 720, 180. If they ask you to pass journal entry, then write this journal entry: cash account debit 900 to NCI 720 and to other equity, that is gain on sale of interest in subsidiary 180. Solve one more question, similar problem. Question number 19. Subsidiary issues shares to a third party. This is a situation where we have not done anything, but the subsidiary issues shares to a third party. Number of shares outstanding will go up, so parent would lose the control. In March 20x1, a group had a 60% interest in subsidiary with share capital of 50,000 ordinary shares. The carrying amount of goodwill is rupees 20,000 at March 20x1, calculated using the partial goodwill method. What is partial goodwill method? That means the non-controlling interest is measured at proportionate share in net asset. Okay. On 31st March 20x1, an option held by minority shareholders exercised the option to subscribe for a further 25,000 ordinary shares in the subsidiary at rupees 12 per share, raising rupees 3 lakh. So some outside shareholders had the option to purchase the share. They purchase further 25,000 share. So what will be the total number of shares outstanding now? Earlier there were 50,000 share plus 25. So earlier 50,000 share was there. Parent was holding 30,000, 60%, NCI 20,000. Now there will be 75,000 shares. Parent will still hold 30,000. The outsiders will hold 45,000 share. So if you look at the percentage, now this is 40% only. Okay. And raising rupees 3 lakh. The net asset of the subsidiary in the consolidated SOFP prior to the option exercise was 4 lakh 50,000. So net asset is 4 lakh 50,000. Goodwill is 20,000. Calculate the gain or loss on the loss of interest in subsidiary due to option exercised by the minority shareholders. What is the gain or loss to the company? So first you understand the status before and after. Write down. Before write numbers, percentage. After write down numbers, percentage. Group is holding 30,000 share, 60%. Other party is holding 20,000 share, 40%. Okay. Total number of share before is 50,000 and 100%. After, group is still holding 30,000 share, but outsiders will hold 45,000 shares, 20 plus 25. So total 75,000 share. Convert into percentages. Now 30 divided by 75, 40%. 45 divided by 75, 60%. Okay. In terms of net asset, write down net asset. Net asset rupees in 1,000 percentage. Rupees in 1,000 percentage. Group share was earlier 60% of 450. 270, write down. And other party 180. After the issue of share, wait, this 450, and what is the amount received by issuing share? 300. So this becomes 750. 450 plus 300. This becomes 750. 450 is already there, plus funds raised by issue of share 300. So this becomes 750. And what are the respective shares? 60% and 40%. So parent share in the group will be now 300 and other party will be 60%, 450. Is this working clear? The question is, what is the gain or loss on deemed disposal Why deemed disposal? Actually, we have not disposed. Subsidiary has issued shares. Subsidiary has issued shares. So write down this journal entry. Investment account debit. Investment account debit. How much will you write? How many shares we have? 30,000 shares we have. At what rate it was purchased? Investment account, today the market value of the share is 12 rupees. So our stake will go down, but this investment will appear in the books now. The subsidiary has become, you can say, associate now. The subsidiary has become associate because now we are holding 40% share in that company. So what this standard says, the fair value on this date, becomes the new cost of investment in associate. Fair value of investment. So we are holding 30,000 share and it has to be multiplied by today's market value, which is 12 rupees. So 360. NCI will go out of the books now because it's no longer a subsidiary. So non-controlling interest 180. How did you reach this 180 figure? We have done this working note here. 180. Is it right? So this 180 non-controlling interest debit to net asset 450 given in the question, to goodwill 20. This will be derecognized. NCI will be derecognized. And the difference, write down, to other equity 70. Gain on deemed disposal. Being gain on deemed disposal. Okay. And then there is a note. For simplicity, it has been assumed that the fair value per share is equal to the subscription price. As control of the subsidiary is lost, the retained interest will be recognized at fair value at the date the control is lost. So that is why we have multiplied the remaining share 30,000 into 12 that we are holding, and now it will become an associate. So further treatment will be as per IS 28. Okay, and this will become the deemed cost for further calculation under IS 28. The resulting remeasurement gain is recognized in profit and loss. So in case if you lose the control, the gain or loss will be recognized through profit and loss account. Now try this question also yourself. A parent purchased an 80% interest in subsidiary for rupees 1,60,000 on 1st April 20x1 when the fair value of the subsidiary's net asset was 1,75,000. Goodwill of rupees 20,000 arose on consolidation under the partial goodwill method. Partial goodwill method means the NCI is measured at proportionate share in net asset. An impairment of goodwill of 8,000 was charged in the CFS on 31st March 2003. So what is the balance of goodwill in the books now? 20 minus 8, 12,000. No other impairment charges have been recorded. The parent sold its investment in subsidiary on 31st March 20x4 for rupees 2 lakh. So 2 lakh bank account debit. Goodwill balance is 12,000 credit, remove it. The book value of the net asset in the CFS on the date of sale was 2,25,000. This also credit, net asset. not including goodwill of 12,000. Goodwill 12,000 is separate. When the subsidiary met the criteria to be classified as held for sale under IFRS 5, no write-down was required. No write-down was required because the expected fair value less cost to sale was greater than the carrying amount. So no adjustment for this. The parent carried the investment in subsidiary at cost as per IS 27. Calculate the gain or loss on disposal of subsidiary in parent separate and consolidated financial statement. Separate financial statement compare the cost and selling price. What is the cost? 1,60,000. What is the selling price? 2 lakh. So in separate financial statement, write down sale proceeds rupees in 1,000, 200 less cost of investment in subsidiary 160. Therefore, gain in SFS 40. Okay. Now you will be given 20 seconds to try and tell me how much is the gain or loss in CFS. How much is the gain or loss in CFS? $8,000. Check. We'll get the answer in two ways. One is either you prepare this table, or second you can pass the journal entries. So first, tabular format. Sale proceed, write down 200. Share of net asset on disposal 80% of 225, that is 180. And we had also paid 12 excess for the goodwill. So less goodwill also, 12. 200 minus 180 minus 12, 8. Sale proceed, this is the value of our net asset, and we had also incurred 12 for goodwill, which is in the books right now. Okay, so value of my investment in the CFS, inside the CFS the worth of my investment is 192 and I realized 200 for that. So 8 is the gain. Other way to understand is by passing a journal entry. So write down journal entry. Bank account debit. How much is bank account debit? 200. NCI account debit 45. NCI account debit 45. Why 45? 20% of 225. 20% of 225. Because NCI in the CFS must be appearing at proportionate amount. And to net asset 225, to goodwill 12, derecognize. Now we are no longer a parent company. So subsidiaries net asset will not appear in our books. Goodwill will not appear. And to other equity. To other equity, how much is the gain? 8. Solve one more question. Question number 21. Partial disposal. Previous question was full disposal. Now partial disposal and subsidiary becomes an associate. If subsidiary becomes associate, the remaining investment will be measured at fair value. Okay, solve yourself. ET Limited purchased 100% subsidiary for rupees 50 lakh on 31st March 20X1, when the fair value of BT Limited, whose net asset was rupees 40 lakh. Therefore, goodwill is rupees 10 lakh. ET Limited sold 60% of its investment in BT Limited. So 100 minus 60, now you are holding 40%. On 31st March 20X3 for rupees 67 lakh 50,000. Leaving the AT Limited with 40% and significant influence at the date of disposal, the carrying value of the net asset of BT Limited excluding goodwill is rupees 80 lakh. Assume the fair value of the investment in associate of BT Limited retained is proportionate to the fair value of the 60% sold, that is rupees 45 lakh. Calculate the gain or loss of proportion of BT Limited on sale of proportion of BT Limited in AT Limited's separate and CFS as on 31st March 20X3. First you will try. What is the gain or loss? We have solved one similar example before. Similar to I think 18 number. Any answer? In separate financial statement, we will write sale proceeds 67.5 lakh, cost of investment in subsidiary 60% of 50 lakh, 30 lakh. Therefore, gain on sale in parent separate financial statement, is it 37.5 lakh? Consolidated financial statement, sale proceed 67.50 lakh. Add fair value of 40% interest retained. Add fair value of 40% interest retained is given to you 45 lakh. This number is appearing there. Less net asset disposed, including goodwill. 80 lakh is net asset and goodwill is 10 lakh. Therefore, you have to remove 90 lakh from your books now, and gain on sale will be 22.50. You can explain this with the help of a journal entry also. So write down journal entry. Bank account debit 67.50. Investment in associate account debit 45. To net asset 80. What we are getting bank and the fair value of remaining investment. What we are derecognizing from CFS, net asset, goodwill, and then two other equity, gain on disposal 22.50. Okay. Now analysis of gain, don't write, it's written. The gain on loss of control will be recorded in profit and loss. How much is the gain or loss? There are two components in that gain or loss. One is the gain or loss includes the gain of 13 lakh 50,000 on the portion sold. 67,50,000 is the selling price, and your stake in that company is 90 lakh into 60%, that is 54 lakh. 13,50,000 is because you have sold the investment, but your total profit was how much? 22,50,000. So then you are wondering why there is a difference. So out of 22.50, 13.50 is due to sale, and remaining is due to revaluation of investment. The investment will also show again because you have valued it at now market value. It also includes a gain on remeasurement of the remaining 40% interest of 9 lakh. But it was valued at what amount? 40% interest is 36 lakh, sorry. But it was valued at 45 lakh. So its carrying amount is 36 lakh, proportionate carrying amount, but you recorded it for 45 lakh. See the entry here again, this one 45. Whereas if I take 90 lakh into 40%, in the books it is worth 36 lakh. Try one more similar question yourself. Come on, fast. 22 number question. Same problem, only the percentage stake sold is 90%. Okay, check the answer. Separate financial statement, how much you got? Separate financial statement, 85.50 lakh is sale proceed, and the cost is 90% of 50 lakh is 45 lakh. So in separate financial statement, the gain will be 40.5 lakh. Is right? Who got the answer for CFS? How much? 5 lakh. Okay. So there are two ways I can present it. One in the form of this table, right? Sale proceed 85.5 lakh. Add fair value of 10% interest retained 9.5 lakh. Less net asset disposed, including goodwill 90. So therefore gain is 5. We can understand it with the help of a journal entry also. Okay. So write down journal entry, bank account debit 85.5, investment account debit, that is the investment retained 9.5, to net asset 80 derecognized, to goodwill 10 derecognized, to gain on disposal 5. Now can you analyze this gain 5? How much is due to sale and how much is due to fair value gain on investment? How much is due to sale? So analysis of gain. First is gain on loss of control would be recorded in P&L account. Gain or loss includes gain of 4,50,000 related to 90% of the portion sold. Understand, 90% of the portion sold. 85,50,000 is the sale value, and 90% of the net asset including goodwill is 81 lakh. So what you have sold is worth 81 lakh and sold for 85,50,000. So therefore the difference is 4,50,000. Remaining 50,000 is relating to remeasurement of the remaining 10% interest. You valued the remaining 10% is at 9,50,000 given, and the 10% of the net asset of subsidiary is 9 lakh. So instead of 9 lakh, you have recorded 9,50,000. So 50,000 gain on fair value measurement of the remaining interest. Now we'll come to question number 36. So first you understand all question up to 35 are over. Yes or no? 1 to 35. All questions are over. 36 number is based on disposal. P Private Limited has a number of wholly owned subsidiaries including S Private Limited. So this company P Private Limited has many subsidiaries, and one of the subsidiaries is S. On 31st March 2012, P Private Limited Consolidated Statement of Financial Position SOFP and the group carrying amount of S Private Limited assets and liabilities, that is amount included in that CFS in respect of S Private Limited assets and liabilities. So you are given two columns. Can you see below? One is consolidated column, which is parent plus all subsidiaries, and one column which only shows out of this entire consolidated figures what is the figures relating to only S Private Limited. For example, goodwill 380 is group, and it includes goodwill relating to S 180. Building 3240 is for the entire group, and how much is the S Private Limited share in that? 1340. Then current asset, same way, inventory, trade receivable, cash, total asset. Equity and liabilities, equity, share capital, other equity, retained earning, current liabilities, trade payable, total equity and liabilities. So you are given group figures. Inside that group figure, how much is the assets and liabilities of S Limited? Prepare consolidated SOFP after disposal. After disposal as on 31st March 2012, when P Private Limited sold 100% shares of S Private Limited to the independent party for rupees 3,000 million. So we have sold the entire 100% shares of S Private Limited. After the sale, you have to prepare the SOFP again. Okay. So in the last 6 or 7 example, what we had done, we had learned to pass journal entry on sale. So first, if you want to understand it in a very easy way, pass this journal entry first. Write down bank account debit 3,000. Write down rupees in million. Remove all the assets and liabilities. Only S Private Limited assets and liabilities derecognize now. Remove. So trade payable account debit 900. Trade payable account debit 900, cash and bank de-recognize 1000, to trade receivable 900, to inventory 40, to PPE 1340, to goodwill 180. All items that they had given to us, I have removed them. And I have only incorporated bank account debit 3000. So dear student, what will be the gain or loss? Check balancing figure. Profit on sale of subsidiary. Is it 440? Balancing figure, right? 440. Now what you have to do, prepare the CBS consolidated balance sheet of P Private Limited on 31st March 2012 after disposal. So what you will do, just give the effect of that one entry in this format. Take the given consolidated figure to you and plus or minus that entry that you have written. Okay, so try. Property, plant, equipment. Will it remain same or will it change? Change. You have to reduce 1340. So what will be the balance in PP after reducing 1340? $1900. Goodwill will also get reduced. 380 minus 180. PP is 1900 is right. Goodwill will be 380 minus 180. 200. Inventory will be 140 minus 40, 100. Trade receivable will be 1700 minus 900 is 800. Cash will have two adjustment. We had 3100. We paid 3000. We received 3000 for sale, and we will de-recognize subsidiaries figure 1000. So how much is the answer now? What is the total? 81. Okay. Equity, share capital. How much share capital? It will remain same. Other equity will change. It was 4260, but there is a profit also. That profit figure you will add here. How much it comes to? 4700. NCI because it's 100% subsidiary, so NCI is not impacted. Is there any existing NCI in the given balance sheet? No. So total equity in the outer column will be how much now? 6300. Okay, then trade payable will be reduced. What is the answer now? 1800. Total 8100. And you also complete this SOCIE. Opening balance of share capital, how much was that? Retained earning, NCI, total, profit on disposal, 440. So 1600. This total is how much? 4700. This total is how much? 6300. Now come to one small paragraph on investment entities. What are investment entities? Why we are discussing investment entities? They are exempted, okay, from consolidation, subject to certain conditions. So come to paragraph number 37. Paragraph 36. Investment entities are entities that invest for return from capital appreciation, investment income, or both, with funds collected from one or more investors. Okay. So is this sentence printed in your book? Investment entities are entities. First point, obtain funds from one or more investor for the purpose of providing those investors with investment management services. So basically their intention is not to run the business. Their intention is to provide investment services to one or more investors. And their performance will be measured. How? How the investment performs. How much capital gain, dividend income, interest they generate from their investment. They measure and evaluate the performance of all its investment on a fair value basis. So first thing is that these entities are primarily involved in investment activities. Funds collected from one or more investor invested into securities for generation of capital gain or investment income, and secondly they should measure the investment on a fair value basis. If these two conditions are satisfied, then such entities are exempted from the consolidation requirement of this standard. Such entities shall measure investment in subsidiaries at FVTPL in accordance with IFRS 9. So that is about investment entities. Investment entities are exempted from consolidation of subsidiaries. And then there is a change in IFRS 10 versus Ind AS 10. What is that change? Actually, it is almost negligible, not very useful for us as a student. Change is in terms of investment property. Why there is a change? I'll briefly explain. As per IFRS 10, all investment properties is to be measured at fair value to qualify for exemption from consolidation available to an investment entity. Just now you have seen. The investment should be measured at fair value. But under Ind AS 40, which is also same investment properties, Ind AS 40 does not permit, do you remember, fair valuation. Rather it will be measured at cost. That is the exemption because of Ind AS 40. According the relevant paragraph of IFRS 10 has been deleted in Ind AS 110 as investment property measured at fair value is not relevant in the Indian context. Okay. Now we'll solve one small question. 38, small, only of 3 pages. Okay. So question number 38, it will take half an hour to first read only. So this can be a question for 50 marks also, 40 marks also, 30 marks also. Alpha holds investment in 2 other entities. The statement of financial position of the three entities on 30th September 2013 are as follows. Figures in dollar in thousand. Assets, non-current asset. Property, plant and equipment, and they have mentioned read note number 1 and 3, but we'll read later. Intangible asset, read note number 1 and 4. Then investment, read note number 1 and 2. Only Alpha has got investments. Current asset, investment, inventory, note number 5. Trade receivable, note number 6. Cash and cash equivalent, this does not have note number. Then total assets, equity and liabilities. Under that equity, share capital, in bracket $1, means face value is $1 per share. Retained earning, other components of equity, note number 2 and 3. Total equity, non-current liabilities, long-term borrowing, note number 8. Deferred tax, total non-current liabilities, current liabilities, trade and other payable, short-term borrowing, total current liabilities, total equity and liabilities. Okay. So this is usual format of SOFP. Now you have to understand note number 1. Alpha's investment in beta. There are two investments made by this company. Which two investment? Beta and gamma. So right now they are explaining to you Alpha's investment in beta. On 1st July 2012, let us look at the date of SOFP, 30th September 2013. Oh, and when were the shares acquired? 1st July 2012. And our consolidation date is 30th September 2013. So how many year and how many months are over? 15 months are over? 1 year, 3 months or 15 months? So at some place we'll have to use this 15 months calculation, like depreciation, interest. Okay. On 1st July 2012, Alpha acquired 120 million shares in beta by means of a share exchange. So share for share. And what is the ratio? By means of a share exchange, the terms of the business combination were as follows. Alpha issued 5 shares for every 6 shares acquired in beta. And how many shares they have acquired? 120. So that is 100. And what is the multiplier? The market value of Alpha share was 2.40 into 2.40. So that means only if I consider share 240 million. The share issue has been correctly reflected in the financial statement of Alpha. So issue of share is there in the books of Alpha. So we are not going to pass entry for this. This has got included in the SOFP. Next line, Alpha will make a further cash payment of $50 million to the former shareholders of beta on 30th June 2015. When did we acquire the share? When will this 50 million be paid? 30th June. After how many years? 3 years. So this is called deferred consideration. We will pay it, but later. So deferred consideration for this will be 50 divided by whatever discount rate they must have given below, 10%. And this is after how many years? 3 years. So actually there are many small simple questions, they are merged into one problem. हाँ जी, 37.57. No problem. So Alpha will make a further cash payment of $50 million to the former shareholders of Beta on 30th June 2015. Alpha has made no entry in its financial statement in respect of this additional payment. So this also I need to incorporate in the cost of acquisition, in the consideration paid for goodwill calculation. Do you agree? Then on 1st July 2012, Alpha's credit rating was such that it could have borrowed funds at an annual rate of 10%. Now one more thing you'll have to do, this liability should have been recognized on 1st July 2012 while passing entry for business combination. But you have not recognized. So you'll have to also recognize interest on that for 15 months. And then the liability now in the SOFP will be this amount and plus interest for 15 months. Okay? And plus we will also reduce the profit of the parent company because of the interest entry. So you will have to also pass interest related entry here. Okay? Interest related entry also we will pass. Next line. It is the group policy to value the NCI in subsidiary at the date of acquisition at fair value. The market value of an equity share in Beta on 1st July 2012 was $1.70 and can be used for this purpose. So what will be the value of NCI in this problem at the beginning? 1.70 per share. And how many shares are with NCI? In the balance sheet there are 150 million share. 120 has been acquired by Alpha. So that means the NCI must be holding how many shares? 30. So multiply by 30. So is it $51 million? That will be the fair value of NCI on the date of acquisition. Then on 1st July 2012, the individual financial statement of Beta showed the following reserve balances. Beta means subsidiary. Retained earning $98 million. So this we will call pre-acquisition retained earning. And other component of equity $5 million. So these are the reserve on the date of acquisition. Okay. So these two figures will be written on the date of acquisition. And now if you see the balance sheet above, retained earning of Beta is 115 and other component of equity is 11. So that means there is some change in the post-acquisition period, no problem. The directors of Alpha carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st July 2012. The following matters emerged. Plant and equipment having a carrying value of 120 million had an estimated market value of 130 million. So what is the increase on the date of acquisition? 10 million. The estimated future life of the plant and equipment on 1st July 12 was 4 years. And this estimate remains valid. Beta has disposed of 20% of this plant and equipment since 1st July 2012. So out of this plant, 20% has been disposed of also. Okay. Which means out of this 10 million appreciation, the asset worth 2 million appreciation has been disposed of. So we have to make here adjustments like increase in the value of the asset and depreciation. Depreciation for 15 months. Depreciation for 15 months. Yes or no? 1/7/12 is the date and now consolidation date is 30th September. So we'll provide depreciation on this for 15 months. Then same thing for intangible asset also. Intangible asset with an estimated market value of 12 million had not been recognized in the individual financial statement of beta. On 1st July 12, the estimated future economic lives of these assets was 5 years. So again, in the pre-acquisition period, you will add 12 million and you will also consider the amortization for 15 months in your calculation. Is it right? Say yes. Yes. The fair value adjustment have not been reflected in the individual financial statement of beta. So you will have to adjust it now for consolidation purpose. In the consolidated financial statement, the fair value adjustment will be regarded as temporary difference for the purpose of computing deferred tax. So this will also give rise to deferred tax adjustment. Because you are going to increase the book value, okay, then it will also have a deferred tax implication. No impairment of goodwill. The rate of deferred tax is 20%. No impairment of goodwill on acquisition of beta had occurred since 1st July 2012. Reverse acquisition ignore for the time being. Okay. But your observation is good. Share capital is 195 and out of that 100 has been issued to the other entity. So number wise speaking, there can be reverse acquisition, but whether control has been transferred or not, we should write a note for that. Okay. Now come to the point number note 2. Note number 2, Alpha's investment in Gamma. On 1st October 2012, there is a second investment Gamma. Now when was this investment made? 1st October 12. 1st October 12. And what is the year ending date in this question? 30th September 2013. So this seems to be 1 full year, right? Alpha acquired 48 million shares in Gamma for a total cash payment of $80 million. Now just tell me 48 million share and there are total 120 million share in Gamma. 48 divided by 120. Is it 40%? So they have acquired 40% share. Okay. The share purchase followed an agreement with 2 other investors who each purchased 36 million shares in Gamma on 1st October 2012 to exercise joint control over Gamma. So what is Gamma? Gamma is a joint venture. If it is a joint venture, IS 28 will apply. Equity method of accounting will apply. In equity method of accounting, what we will do? Increase the carrying amount of investment. Increase or change the carrying amount of investment. Okay, carrying amount of investment. And second effect we will give in the corresponding P&L account or reserve. Is it right? That is the main thing that we do in equity method. Calculate the proportionate share of venturer or investor, one effect in the carrying amount of investment and one effect in the either P&L account or respective equity item. Okay. Next line. All key operating and financial policies, including the distribution of profit, require the unanimous consent of the three investors. So it's a joint control. In its own financial statement, Alpha treated the investment in Gamma as a financial asset and made an election to measure it at fair value through other comprehensive income. On 30th September 13, the fair value of the Alpha's investment in Gamma was 82 million. Now you see, what was the cost of acquisition? 80. And what is the fair value? 82. So what is the increase? 2. So these two appearing in the individual financial statement is as in change in the fair value of joint venture, which means this 82 must be appearing in the given balance sheet also in the investment total. So now your investment total is matching. How is it matching? 240 is the investment in beta plus 82 is the fair value of investment in joint venture. So that is how they have arrived at 322. Is it right? Next line. Alpha Limited did not recognize any deferred tax in respect of this restatement to fair value. So no deferred tax adjustment was made for this increase in 2 million. Next line. Alpha Limited did not recognize any deferred tax in respect of this restatement to fair value. Therefore, on 30th September 2013, Alpha credited $2 million to other components of equity. So in that other component of equity, 192 million, can you see in the balance sheet 192? It includes 2 million of this change in the fair value of joint venture. So when we are preparing CFS, this entry first we will reverse. First we will reverse the entry and then apply IAS 28. So 2 million we will reduce from investment and 2 million will reduce from other component of equity. What is the next paragraph? On 1st October 2012, the individual financial statement of Gamma showed the following reserve balances. Retained earnings 66 million. Other component of equity $0. So this will help me to find out how much was the post acquisition profit of Gamma. Because share in post acquisition profit, I need to add in the profit of the parent company. Then it says on 1st October 2012, there was no material difference between the carrying value of net asset of Gamma in the individual financial statement and the fair value of those net asset. Very good. So no fair value adjustment. You do not need to consider the deferred tax implication of Alpha's investment in Gamma when preparing the consolidated statement of financial position of Alpha Group. So wherever they ask you not to consider deferred tax implication, don't consider. And whenever they are asking you to consider deferred tax implication, you will consider. So like, for example, while revaluing the assets, that time you will have to consider. But right now, for this investment in gamma, no deferred tax adjustment. Note number 3, property, plant and equipment of beta. Beta measures its land under the revaluation model. The other component of equity of beta consists entirely of revaluation surplus arising on the revaluation of the land. Let us go to the balance sheet and look at other component of equity. How much is that? Is it 11,000? 11,000. And how much was the opening balance? 5,000. Opening balance was 5,000. Okay. On 1st July 2012, the carrying value of beta's land in the beta's own financial statement was same as the fair value. On 30th September 2013, beta revalued its land by 7.5 million. As a result of this revaluation, beta recognized an additional deferred tax liability of 1.5 million and credited 6 million to the other component of equity. How did you get 6 million? 7.5 minus deferred tax liability 1.5, 6 million. So you have learned in your other chapters, say for example IAS 12, if you record the gain or loss in OCI, the deferred tax will also be recorded in OCI. So the net effect in OCI will be 6. Okay. And it means there is a deferred tax liability on this item 1.5. It means there was a revaluation done here of 7.5. What is the group policy? Let us read further. We have to first visualize what they have done, and we have to also know what should be done now. Okay. And what will be the double effect of your adjustment. As a result of this revaluation, beta recognized an additional DTL of 1.5 million, credited 6 million to OCI. So what entry they must have passed? For example, that plant and PP account debit, how much? 7.5 to DTL 1.5 to OCI revaluation reserve 6. Next line, I will read from your book. Come to your book again. The policy of alpha and gamma is to use cost model to measure all the property, plant and equipment, and this is the policy to be adopted in the consolidated financial statement also. So you'll have to reverse this effect. You'll have to reverse this effect. Next point 4. Intangible asset of alpha and beta. Now they are talking about both the companies, alpha and beta. The intangible assets of alpha, alpha is the parent company, comprises expenditure incurred during the year on a project to reduce the wastage incurred during the group's production process. The project began on 1st November 12 and is expected to be complete by 31st May 14. Expenditure to date has been $5 million each month. How much they are incurring on this project? 5 million. So this, they are trying to develop some technical know-how. This technical know-how is going to reduce their wastages. They are incurring $5 million per month on this. On 1st June 2013, the directors were able to assess the technical feasibility and commercial viability of the project. When this project started? This project started on 1st November 2012. When was technical feasibility and commercial viability was demonstrated? 1/6/13. This is 1st November. How many months are over? Can you count? 7 months are over. November, December, and 5 months. So 35 million they have incurred before technical feasibility is demonstrated. Next line. At this date, they also received assurance that the economic benefit the projects was likely to bring to the group was likely to exceed the total project cost. So technical feasibility, commercial viability, future economic benefit have been demonstrated. So they should have capitalized the expenditure incurred after this date. But what they have done? They have capitalized the entire expenditure. Okay. At this date, they received the assurance about this. Next line, the intangible asset. So now you go to first the balance sheet. Search for intangible asset of Alpha. How much is that? 55,000. Can you see 55,000? Why 55,000? 5,000 into 11 months. Total number of months over are 11. But out of that, 35 we will treat it as research expenditure. So 35 we will write off. 35 we will write off. Before development start, the earlier phase expenditure will be written off. Which standard they are applying here? IS 38. Okay. So 35 we will write off. The reason is this will be treated as research expenditure. Next paragraph in note number 4. So the only benefit of this paragraph 4 so far is write off 35. Intangible asset being research expenditure. The intangible asset in the individual financial statement of beta represent goodwill, which arose on acquisition of an unincorporated business in 2008. No impairment of goodwill has been necessary since the date of acquisition of beta by Alpha. Now there is some intangible asset in the books of beta also, which is 60,000. Is it there? While calculating the cost of acquisition and the net asset acquired, the existing goodwill of acquiree we will not consider. The existing goodwill of acquiree will not be considered. We will only consider the net asset. Goodwill is what is the balancing figure we will get for. So this 60,000 will not be considered on the date of acquisition. This we will deduct from the net asset. Is it right? Goodwill in the books of acquiree will not be considered for the purpose of calculating goodwill on the date of acquisition. IFRS 3. We will calculate our own goodwill as a balancing figure. So remove that 60,000. Next line, point number 5, note number 5. These are easy points now, relax. Intercompany sale of inventory. The inventory of beta and gamma on 30th September 2013 included component produced by Alpha. So Alpha has sold to beta, Alpha has sold to gamma. So who is the seller in both cases? Alpha. Beta is a subsidiary, gamma is a JV. In case of beta, 100% elimination of the profit. But in case of joint venture or associate, only the share of investor or venturer is eliminated from unrealized profit. Is it right? So this time you have to be careful. The selling price of component included in the inventory of beta was 14 million. 14. And in gamma, 12. Alpha applied a markup of 1/3 of its production cost. 1/3 of cost means 1/4 of selling price in order to arrive at selling price of this component. So this will be 3.5. But this I will further multiply by 40%. Only the share of investor or venturer will be eliminated. So how much is that? 1.2. Where is the inventory? The inventory is with beta. Beta's assets and liabilities will be consolidated with alpha. So this 3.5 adjustment will be made in inventory. Where is this inventory? With gamma. Gamma's assets and liabilities are not consolidated with alpha. So this adjustment will be made in investment in gamma. This adjustment will be made in investment account. IS 28. Okay. In case of downstream transaction to joint venture or associate, first point, our share in unrealized profit will be calculated only. And if it is downstream, the investment account will be adjusted. Had it been upstream transaction, then the inventory is with alpha. Then inventory will be adjusted. Okay. Next paragraph. What is the next line? You can ignore deferred tax when making any of the adjustment due to the information in this note. So deferred tax ignore for this. Then trade receivable and payable. Again very easy. The trade receivable of alpha included 8 million receivable from beta. So deduct 8 million there and 7 million from gamma. Don't adjust. 7 million from gamma, do not adjust. Why? It is a JV. JV's assets and liabilities we are not consolidating. Okay, so now this kind of adjustments are given to test your knowledge of the two subjects, two topics. In subsidiary case, assets and liabilities are consolidated. So eliminate. In case of associate and joint venture, assets and liabilities are not consolidated. So therefore, you will not eliminate this 7 million receivable in respect of purchase of components. See note number 5. The trade payable of beta and gamma included equivalent amount payable to alpha. So from trade receivable and trade payable, you remove 8 million each. Do not do adjustment for 7 million. Note number 7. Forward currency contract. So now they will take you to IFRS 9. Is it right? Forward currency contract covered in IFRS 9. During July and August 2013, Alpha conducted a large marketing effort in country X. The currency in country X is euro. Alpha made no sales to customers in country X in the year ended 30th September 2013. No sales have been made, but is very confident of making substantial sales to such customer in the year ended 30th September 14. That means there is a forecasted sales transaction. We will call it forecasted sales transaction. On 5th September 2013, Alpha entered into a contract to sell 20 million euro for $28 million. This is called forward contract. Okay. On 30th September 2013. Currency fluctuation in September 2013 was such that on 30th September 2013, the fair value of the currency contract was $1.1 million, a financial asset. So you have to create a financial asset. Forward contract financial asset account debit 1.1 million. To cash flow hedge reserve 1.1 million. Is it right? So we have to pass one small entry under IFRS 9. Forward contract asset account debit 1.1 to cash flow hedge reserve 1.1. The draft financial statement of Alpha do not include any amount in respect of this currency contract since it has a zero cost. So this transaction is not appearing in their balance sheet right now. Alpha wishes to use hedge accounting whenever permitted by International Financial Reporting Standard. So if you want to use hedge accounting, then you will not recognize it in P&L account immediately. Is it right? Then you will recognize it in cash flow hedge reserve. So it will first come in other component of equity. And in future, when the sales will be recognized, then this will be recycled to profit and loss account. Alpha expects sales to customer in country X to be at least 22 million in October 13. So this is a hedge of a forecasted sales transaction. So this we will treat it as cash flow hedge reserve. Okay. Long-term borrowing. If nothing is given, all are effective. Okay. Yes or no? Yes. Go ahead. It's already too complicated. To compute the effective ineffective portion, the data is also, I don't think, is enough. Now come to long-term borrowing. Now this is also from IFRS 30, IAS 32. This adjustment is from IAS 32. Read and you will understand. The long-term borrowing of Alpha include a loan at a carrying amount of 60 million. So loan contains a specific loan mentioned here, 60 million, which was taken out on 1st October 12. And what is the year ending date in this question? 30th September. So which means exactly 1 year before. For interest calculation, it will be easy. The loan does not carry any interest, but 75.6 million is repayable on 30th September 15. Means after how many years? 3 years. This represents an effective annual rate of return for an investor of 8%. As an alternative to repayment, the investor can exchange their loan asset for equity share in Alpha on 30th September 15. So this is a compound instrument because it is convertible into equity share at the option of the investor. The annual rate of return required by such investor on a non-convertible loan would be 10%. So what I'll do, I'll first find out what is the equity component and what is the debt component. So we are going to pay 75.6 after 3 years if the investor opts for cash. This cash cannot be denied. So what is the present value of this? Take 75.6 divided by 1.10, 3 times equal to 56.80. This will be the liability component. Okay. So 60 is the total cash flow you received today. So the remaining 3.20 is equity. So this also I will add to other component of equity. This I will recognize at the beginning, but I am going to add 1 year interest to that based on effective rate, that is 10%. 8% we will not use in the calculation. Okay. Next line. The Alpha Limited has not charged any finance cost in respect of this loan. So you will charge. So this will affect your retained earning figure. This will affect your liability figure. So retained earning account debit to loan liability, interest for 1 year. And then to confuse you, they have given you two present value factor. The present value of $1 payable receivable in 3 year time is as follows. 79.4 cents when the discount rate is 8% and 75.1 cent when the discount rate is 10%. So 75.1 cent means if it is $1 after 3 years, its present value is 75.1 cent means 0.751. Is it right? So you have to multiply by 0.751 into 75.6 so that you will get the present value, which we have calculated 56.80. But if you apply their factor, it will come to little different. How much? 56.78 or something. No problem. We'll follow the guideline given in the question. And now the final line. Prepare the consolidated statement of financial position of Alpha at 30th September 13. Note, you should show all working to the nearest dollar in thousand. The instruction is given, you have to answer in dollar in thousand. Okay. So first you understand the formats that I am going to use based on our discussion. Of course, you can use any other format of your choice. Okay. This is one way to solve. This is your main answer. Consolidated statement of financial position. Okay. And then we have one working note, which is net asset table of beta. What is that net asset table of beta? Now this we will divide into two columns. One column, that is the position on the date of acquisition 1st July, and second column is the position on 30th September 13. This is one more simple way to present your answer. If you can understand this, then you can follow this technique for all other questions also, whichever method is convenient. Now here I will write what was the net asset as on first. So this will help me to calculate the goodwill. This will also help me to calculate the NCI share if it is based on net asset. Okay. This will give me closing net asset. The difference between the two is the change in the net asset. Parent share in the change in net asset will be added to parent. NCI share in the change in net asset will be added to NCI. Okay. And whatever adjustment they have mentioned, that you have to properly write here. Okay. So this you can treat like a pre-acquisition column, and this you treat like a post-acquisition column. Only thing is we are also writing here share capital. Otherwise, remaining item normally in any case we write in pre and post working note. Next working note is goodwill on consolidation. That will calculate for beta. Beta is subsidiary. Then NCI in beta. Fourth is retained earning, which has lot of adjustment. Fifth is other component of equity. If you want, you can merge all this in one heading, statement of changes in equity. NCI, retained earning, this other component of equity. But that will become too messy, so we have just kept it separate. Okay. Next is tangible asset, intangible asset, deferred consideration, then convertible loan, equity component, investment in Gamma. Gamma is a joint venture. So I have to make two adjustments in this. share in the post-acquisition profit, and unrealized profit on stock. And then all deferred tax adjustment will write here. And then whatever is the change in the deferred tax will transfer to balance sheet. Disclosing deferred tax will transfer to balance sheet. This much you have to visualize. Okay. In the exam, the formats will not be there. But with some practice, at least you will get an idea that these are the formats we may require. Whichever items have adjustment, means we will require format for that. Some formats are always required, like goodwill, net asset table, or analysis of profit table. NCI, either you prepare NCI statement of changes in equity, or you prepare it as a separate item. Retained earning, other components of equity. Okay. And then according to question, some more extra working note you have to prepare. So now we will start this wonderful question. Ready? Now one small warning, Gamma's assets and liabilities will not be added. Gamma is a joint venture. So property, plant and equipment, since there are many adjustments, we'll go to working note number 6. In working note 6, you take your calculator, alpha plus beta. How much is alpha plus beta together? Only alpha and beta. 555? Huh? In 1000. And you are given balance sheet. So 555,000. It's already in 1000. The balance sheet is already in 1000. So 555,000. Okay, keep it here. We'll come back to this. Intangible asset 55,000. Now see this working note 7. Intangible asset, I will do it now. So first alpha. Alpha as per own financial statement, write 55,000. But if you have read the problem, remember we have to write off the expenditure from November to May. This expenditure was incurred before the technical feasibility, commercial viability and future economic benefit was proved. So that comes to 5 into 7. How much? 35,000. So 35,000 write down in bracket. Calculation write down 5 into 7 months. Okay. This you put in bracket. This will be for this company. And what about beta? We'll give second effect also. Second effect, where will you give second effect of this? In the reserve, which means retained earning. So in reserve you write down adjustment for intangible asset. Adjustment for intangible asset 35,000. Second effect will go to retained earning. Okay. Then what about the intangible asset of beta? This 60,000 represents goodwill. That goodwill we will adjust in our net asset table. Adjustment for goodwill. You remove it here also, and it will not appear in closing also. 60,000, 60,000. Is there any other note on this intangible asset of note number 1? Second last paragraph. So that we will solve when we'll come to that. Okay. First we'll eliminate the balance sheet items. So 60,000, 60,000 we'll eliminate from both opening and closing. Now we will come to next item is investment. 3,22,000. Out of 3,22,000, how much is paid for this Beta Limited cost of investment? 240. So write here 240. Sorry, I have written 120. 240. 000. Right. And what about the remaining 82,000? Now first to come to investment in Gamma. Investment in Gamma, how much will you write? 80. 80. But it is only 320. It's only 320. Where is the 2000 effect will give? 2000 effect will give on other component of equity. Working note 5. This 2000 was credited to other component of equity. Now since we are doing consolidation under IFRS 10, the effect given in IS 28 we will reverse. So reverse it. So now it is telling. Okay. 2000 here. Next item is inventories. Come to the balance sheet. In balance sheet, write down inventory. Just tick mark 88,000. Then tick mark 61,000. This adjustment we'll discuss later. Okay. Next item, trade receivable. Tick mark this 65,000. Tick mark this 49,000. Other discussion later. Then cash and cash equivalent 12,000 plus 10,000. This figure I can write in the outer column now also. How much is that? 22,000. 22,000 right here. Cash and cash equivalent, total asset, equity, share capital of parent, right directly here. There is no working note for this. 1,95,000. And what about share capital of subsidiary? 1,50,000. That I will write in net asset table. Share capital 1,50,000. Both column. If you don't want to write here, then you can write in only goodwill working. Share capital. And what about the share capital of the Gamma? Will it also come in the answer? No. Next is retained earning of parent, 1,85,000, working note number 4, 1,85,000. Alpha, first line. Then other component of equity, 1,92,000, working note 5, 1,92,000. And what about the subsidiary? Subsidiary in net asset. First you write down whatever they have given, then I will do the adjustment. Other component of equity, subsidiary, is 5,000, is given in the note 1 below. Somewhere below it is written other component of equity on 1st July was 5,000, and now in the balance sheet is 11,000. Then retained earning. What was retained earning? 98,000. Right in front of retained earning, 98,000. And what is the retained earning now? 1,15,000. 1,15,000. What about subsidiary? No, joint venture? Ignore. Right. That is actually required for calculating post acquisition, we will use it. So 75,000 is appearing in books right now. And what was the amount on the date of acquisition? 66. So 75,000 minus 66,000. 9,000. What is our share in that? 40%. Take 40% of 9,000. You answer in 1,000, otherwise we'll get confused. Or everybody will talk in terms of 1,000. What I have to write exactly? Tell me. 3600 gamma, 40% of difference. And what about the second effect? The second effect will be in the working note number 11. We will add our share in the carrying amount of investment, 3,600. Okay. Back to balance sheet. Other component of equity is nil, so no problem. Total equity, non-current liabilities. First you come to SOFP, tick mark. Long-term borrowing, tick mark 1,70,000 and tick mark 54. Then deferred tax, working note 8. Go to working note 8. Deferred tax, no, working note 12. Wait a minute. Deferred tax 50 plus 35 tick mark. 50 plus deferred consideration. Oh, I got confused. This is 50 and 35. Other adjustment we will discuss later. Now we'll come to total non-current liabilities, current liabilities, trade and other payable. Trade and other payable tick mark 48,000, 45,000. Short-term borrowing 22 plus 5, no adjustment in short-term borrowing. So what is the total? 27,000. Is it right? current liabilities, then total equity and liabilities. Now the show begins. On 1st July 2012, Alpha acquired 120 million shares in beta by means of a share exchange that we have written here on the screen, working note 2, and this entry has already been passed by them, so no effect. The market value of Alpha was 2.40. The share has been correctly reflected in the financial statement of Alpha. Alpha will make a further cash payment of $50 million to former shareholders of Beta on 30th June 2015. Alpha has made no entry in its financial statement in respect of this additional payment. On 1st July 12, Alpha's credit rating was such that it could have borrowed funds at an annual interest rate of 10%. So now you come to working note 2, add deferred consideration. On the date of acquisition, 50 divided by 1.10 to the power 3. 37,566. Are you getting approximately? Then second effect, there is a working note 8 on this in the notes. Working note 8, deferred consideration. Is it there? So right there, the same figure, 37,566. Now wait, I'll complete this also. Interest. First I will calculate interest for 3 months. July, August, September at 10%. So can you tell me 10% of 37,566 into 3 by 12? 939, round off. 939. Add 939. So what is the balance on 1st October? 38505, right? Now you add 10% of this number, 3851. 3851. Again add 42356. 42356. Now understand, this figure we will transfer to balance sheet. But you have passed 2 entries for interest, 939 and 3851. So second effect of interest, retained earning. Okay. So first let us come to balance sheet. Deferred consideration. Tell me the final figure. How much was that? 42356. Okay, 42356. And the interest total of both figure in retained earning, you will see it is written finance cost on deferred consideration 939 plus 3851. Working note 8, 4,000 in bracket 4790. Because this is an expense, we have not accounted for it, so my retained earning will fall. Is it right? So far so good. Next line. It is the group policy to value the NCI in subsidiary at fair value. Market value of equity share in Beta on 1st July 12 was $1.70 and can be used for this purpose. So on the screen, working note 2, fair value of NCI on the date of acquisition. This will come in goodwill calculation also and in NCI valuation also. So 30 into 1.7. How much? 51? 51,000. And you write here also in working note 3. In working note 3 also write 51,000. Okay. Okay. Continue. Next line. On 1st July 2012, individual financial statement of Beta showed the following reserve. These two figures I have written here. Can you see on the screen? 98 and 5. Next line. The directors carried out a fair value exercise to measure the identifiable assets and liabilities of Beta on 1st July 12. The following matters emerged. Plant and equipment having a carrying value of 120 million had an estimated market value of 130 million. The estimated future economic life of plant and equipment on 1st July 12 was 4 years, and this estimate remains valid. Beta has disposed of 20% of this plant since 1st July 2012. Okay. So now you come to working note 1, net asset adjustment. There it is written plant and equipment. Plant and equipment adjustment. By what amount it increased? 10,000. But we have sold 20% of it. So its effect in the closing balance sheet is only 8,000. And what about depreciation? Now there are two possible arguments. Whether we should take depreciation on 10,000 or 8,000. Depends when the asset was sold. Asset was sold on 1st July, then 8,000. Asset was sold on 30th September, then 10,000. So we will assume it was sold in the beginning only. So take extra depreciation. Extra depreciation 8,000 into 15 months. Into 15 months divide by 48 months. So how much is that? 8,000 into 15 divided by 48. 48 means 4 years. How much you are getting? 2,500. Positive or negative? Negative. Now second effect of this fair value adjustment will be in that tangible asset, that is PPE, on the screen, line number 3 there. Fair value adjustment beta, value will increase by 8,000, reduce by 2,500. So how much is that? 5500. 5500. But there will be a deferred tax implication also for this. Okay. There will be deferred tax implication on this. So you come to one deferred tax, working note number 12. In working note number 12, you write deferred tax on fair value adjustment. So in the first period, 1st July 12, plant and equipment 10,000 we have increased, and the effect on this last balance sheet is 5500, 30th September. Okay. So once we complete this entire items, then we'll compute 20%, because one more item is pending. Next line. Intangible asset with an estimated market value of $12 million had not been recognized in the individual financial statement of Beta. So again you come to net asset. You will find one intangible asset adjustment written there. So you add 12,000 opening, 12,000 closing, and in closing you write amortization expense. 12,000 into 15 months divide by 60 months. 60 months means because life is 5 year. So how much is that? Anybody? Come on. 2000? How much? 3000. Okay, 3000. 3000 in bracket. And this has a deferred tax implication also. So come to that working note number 12, intangible asset adjustment. First column, write down 12,000. And second column you write down how much? 12 minus 3. 12 minus 3, 9,000. So what is the net taxable temporary difference? Net taxable temporary difference. You are increasing the value of assets in the books. Carrying amount is more than tax base. Will give rise to deferred tax liability. So this is 22,000. Say yes. And second column 14,500. Take 20% of this. 20% is 4,400. And 20% is 2,900. $2,900. This 2,900 will go to balance sheet, closing balance. Okay. Come to balance sheet. How you tick mark this first? Tick mark this 2900. Okay. There is one more, we'll come to that. At least you tick mark this. And this deferred tax calculation you also write in net asset table. 4,400 here. In bracket, right? And this is 2,000. Liability means you reduce it. If it was asset, you will add it. Okay. Next line says the fair value adjustment have not been reflected in the individual financial statement of beta. Now we have done. In the CFS, the fair value adjustment will be regarded as temporary difference for the purpose of computing DT. The rate of DT to apply is 20%. Done. No impairment of goodwill on acquisition of beta has occurred since 1st July 2012. Good. So we have completed note number 1. Now we'll continue in the next lecture.